Last week, after silver crashed 37%, you felt it in your gut. That sick feeling. The doubt. The voice in your head saying, maybe I should just sell and stop the bleeding. And you know what? That's exactly what they were counting on, because while you were staring at red numbers on your screen, while financial media was running headlines about the silver collapse, something completely different was happening in the background. I started noticing unusual activity, not just price action. That's theater. I'm talking about what the smart money was actually doing while everyone else was panicking. Large institutional flows, derivative positioning that made no sense if this was really a crash, physical metal moving in directions that contradicted the narrative, and then I connected it to a date that keeps appearing in financial analysis circles. February 15th. Not as a prediction, not as a rumor, as a deadline that suddenly has significance across multiple sectors, energy policy, trade negotiations, and monetary frameworks. I can't prove a secret meeting happened. I'm not going to claim leaked documents or insider sources. But what I can show you is a pattern of behavior that suggests something major is being positioned for mid-February. And once you see this pattern, you'll understand why selling your silver right now might be the worst financial decision you could make. This video will show you what I found. Stay with me. Let me explain what a shakeout actually looks like. It's not a conspiracy theory. It's a documented market behavior that happens before major moves. The mechanics. Think about how institutional money works. If you're managing billions and you want to build a massive position in an asset, you have a problem. You can't just start buying. Your own demand would drive the price up before you finish accumulating. So what do? You create conditions that make everyone else want to sell. Goal number 1, clear the leverage. Look at the silver market before the crash. It was absolutely loaded with leveraged positions. Retail traders using 10x, 20x margin. Hedge funds with enormous derivative exposure. When the crash hit, every single one of those positions got liquidated. Forced selling, margin calls, automatic stop losses triggering in cascades. The market got cleared of all the speculative, weak-handed money. Now here's the question. If you were planning a major accumulation, wouldn't that be exactly what you'd want? A clean slate with no competition? Goal number 2, break retail confidence. They needed average investors, people like you and me, to believe that silver was finished, too volatile, too risky. Why? Because when the real move happens, they don't want a million retail investors competing for the same physical metal they're trying to accumulate. Think about the psychology. If you're scared enough to sell at $75 or $100, you're probably not going to jump back in at $90 or $100. You'll sit on the sidelines, exactly where they want you. The signal in the noise. But here's what most people missed during the panic. While the price was crashing, physical premiums didn't collapse. In some markets, they actually went up. While paper silver was getting hammered, actual metal was being quietly absorbed. That's not normal crash behavior. That's accumulation disguised as liquidation. And it's happening right before a date that matters, February 15th. So what's special about February 15th? Let me show you what I found. I'm not going to tell you there's a secret agreement. I can't prove that. But I can show you a series of publicly documented events and timelines that all converge around mid-February. What's actually scheduled? Here's what we know for certain. U.S. Treasury reporting. Deadline, February 15th is a significant reporting date for foreign exchange stabilization operations. Chinese Lunar New Year, late January, early. February 2026, historically a period when Chinese central bank activity increases dramatically. Green energy policy. Deadlines. Multiple countries have mid-February 2026 deadlines for renewable energy procurement targets, which require massive silver supply. Derivative contract rollovers. Major silver futures contracts have unusual concentration of open interest around the February 15 to 20 window. None of this is secret. It's all public information. But when you connect the dots, you see something interesting. The shared incentive. Now, let me propose something that's not a conspiracy. It's just game theory. Both the US and China face the same strategic challenge right now. The dollar and the yuan are both fiat currencies. Their power depends on them being the dominant options for global trade and reserves. But there's growing momentum toward alternative systems, commodity-backed currencies, digital alternatives, regional trade systems that bypass both of them. If you're running the US Treasury or the People's Bank of China, what's your nightmare scenario? A truly neutral, commodity-backed alternative that undermines both your systems. Why silver makes sense? Here's where it gets interesting. Gold is too political. China has been accumulating it aggressively, which creates obvious tension. But silver? Silver is both a monetary metal and a critical industrial commodity. It's essential for solar panels, electric vehicles, electronics manufacturing, 5G infrastructure, military technology. Whoever controls silver pricing controls a huge chunk of the green energy transition. And if both superpowers have an interest in stable silver pricing at a higher level than current markets reflect, what would that look like? Let me show you the analysis that changed my entire perspective. I'm not going to claim I have leaked documents, but I can show you the math that multiple commodity analysts are quietly discussing. The valuation gap. Here's the fundamental problem with current silver pricing. At 75 Oz, silver is dramatically undervalued relative to 1. Industrial demand growth, 20-year projections for green energy. 2. Historical gold to silver ratio, currently distorted. 3. Cost of production. Many mines barely profitable at this level. 4. Strategic value as both commodity and monetary hedge. Now, several independent analysts, using completely different methodologies, keep arriving at similar numbers. The range that keeps appearing. When you model silver pricing based on projected solar panel manufacturing through 2030, electric vehicle adoption targets, 5G infrastructure build-out, historical monetary ratios, you consistently get valuations in the $140 or $180 range, not as a spike, as a sustainable new price level that reflects actual industrial demand plus monetary premium. Some analysts go higher, some go lower, but the central tendency in serious commodity research is clustering around 150, 160. What this means: current price, $75, analytical fair value, $150. That's a 100% gap. Now think about timing. If major institutions understand this gap exists, and they know significant policy actions are coming in mid-February, what would they do right now? They'd accumulate, aggressively, at suppressed prices, and they'd want to do it before the broader market figured it out. The historical precedent. You might be thinking, this sounds too convenient, but this has happened before? Let me show you. Governments have repriced strategic assets before. It's not theoretical, it's historical fact. Case study, Nodra 1, the 1933 gold revaluation. In 1933, FDR faced a banking crisis and a collapsing economy. His solution? First, Executive Order 6102 required citizens to turn in gold to the government. Then once the government controlled the supply, he revalued gold from $20.67 to $35 per ounce by decree. That's a 69% increase, overnight, by government decision. Why? To devalue the dollar, recapitalize banks, and reset monetary conditions. Case study. Circa 2, the 1985 Plaza Accord. September 1985, the Plaza Hotel in New York. Finance ministers from the US, Japan, Germany, France, and the UK met privately. They agreed to coordinate interventions to deliberately devalue the dollar. No public announcement beforehand. No market vote. Just a decision. The result? The dollar fell 51% against the yen over 2 years. This was coordinated monetary manipulation, executed by major governments, successfully. Case study, number 3, the 2015 Chinese gold shock. For years, China denied accumulating gold reserves. Then, in 2015, they suddenly announced they'd increased holdings by 57% over the previous 6 years. The market repriced overnight, but the accumulation had already happened in silence. The pattern. What's the common thread? 1. Strategic accumulation happens quietly. 2. Official announcements come after positioning is complete. 3. Markets reprice rapidly once the new framework is revealed. 4. Early holders benefit massively. Late movers get crushed. Why silver fits the pattern. Silver is in the exact same position now that gold was in 1933 and currencies were in 1985. It's mispriced relative to strategic importance. It's essential for future economic infrastructure, and it's a small enough market that major players can actually influence it. But here's the part that concerns me. There's a control mechanism that could come with any new framework. Let me explain what I'm seeing in regulatory discussions. If silver is going to be treated as a strategic asset, that comes with regulatory implications. I'm not claiming secret laws. I'm showing you what's already being discussed in public policy forums. Trend number 1, enhanced commodity tracking. The U.S. Treasury has proposed expanded reporting requirements for precious metals dealers. The threshold? Transactions over $10,000 currently require reporting. Proposals would lower this to track smaller accumulations. This isn't implemented yet, but it's in active discussion. Trend number 2, strategic resource classifications. Several countries are exploring critical materials, classifications that would give governments more control over supply chains. Silver is explicitly mentioned in these frameworks because of its role in defense and energy technology. Trend number 3, export control discussions. There's growing talk in trade policy circles about restricting exports of strategic commodities. including silver, to ensure domestic supply for industrial needs. What this means for you: if you're already holding physical silver, these trends actually protect your position. Why? Because once these controls are in place, new accumulation becomes harder. More bureaucratic hurdles, more reporting requirements, potentially higher transaction costs, possible restrictions on moving metal. Your existing holdings become more valuable, not just from price appreciation, but from scarcity of unrestricted supply. The window. If these regulatory frameworks are coming, and the policy discussions suggest they are, then the time to position is before they're implemented, not after. Before February 15th, you can still accumulate freely in most jurisdictions. After, that might change. Let me bring this all together with what you need to understand right now. So here's what we actually know. Silver crashed 37% in a pattern consistent with institutional accumulation. Physical premiums stayed elevated even as paper prices collapsed. Multiple significant policy deadlines converge around mid-February. Independent analysts value silver at 100% above current prices. Regulatory discussions suggest increased government interest in silver as strategic asset. Historical precedent shows governments can and do reprice strategic assets. I'm not asking you to believe in secret meetings or leaked documents. I'm asking you to look at the pattern. The fundamental question: do you really think the 37% crash was just random? Do you think it's coincidence that institutional flows contradicted retail panic? Do you think major governments aren't paying attention to a commodity that is essential for their entire green energy future? Your choice. You can believe the fear, sell into the crash, lock in losses, watch from the sidelines, or you can trust the pattern. Hold your position, refuse to be their exit liquidity. The choice is actually simple. Do you want relief from short-term pain, or do you want to avoid long-term regret? I need your verdict. Comment below. Holding, if you're not selling. Buying, if you see this as opportunity. Skeptical, if you think I'm reading too much into this. I genuinely want to know where this community stands. And subscribe, because on February 16th, I'll be doing a complete breakdown of what actually happened. Whether it's a major announcement, quiet policy changes, or nothing at all, we'll analyze it together. Don't panic sell. Get positioned. The math doesn't lie. The pattern is clear. Let's see what February brings.